Welcome to Jay's Corner. My name is Jay O. I am the certified financial planner. I'm also the author of Maximize Your Medicare, the published book. Jay's Corner is there to try to explain how certain financial matters work, to try to help you separate the signal from the noise, so that when something changes, you're not distracted wrongly, and instead keep your eyes on the ball, which is tough to do given the way that we are given information. There's a free and paid newsletter. Go to jo.substack.com. There are two YouTube channels, Jay's Corner as well as Maximize Your Medicare. Be sure to like and subscribe to this podcast on Apple Podcasts, Google Podcasts, anywhere you digest your podcast. Be sure to leave your comments. Let's begin. Good morning, everybody. My name is Jay. Welcome to Jay's Corner. It's a live stream here. Today is, what day is today? Oh my goodness, it's September 23rd, 10 a.m. Eastern Time. It's autumn already. I think today's the first day of autumn, isn't it? Or yesterday. Anyway, for newcomers here, free newsletter there, jo.substack.com. I put the link in the chat. We're not going to exceed 1 hour today. We're going to go to another subscriber-only paid subscriber stream right at 11 o'clock, where I'm going to be talking about some more complicated matters. The fact of the matter is, I believe that personal finance is knowable. It's complicated. There's all this jargon. There's noise. There's politics. There's partisanship. They've got, philosophy. I don't have any time for any of that, right? Which means I'd rather that you just have facts in plain spoken English that I'm trying to make it so that everyone can understand, irrespective of your age or experience. Couple updates here, which the first ones are that, first of all, what we have is we've got public appearance. Next 10 days or so, I'm going to be in Ann Arbor, Michigan, at the Ann Arbor Public Library. And before that, on October 2nd, for paid subscribers, I'm going to take you through Medicare. This is the presentation that I've given nationwide to many, many, many different types of organizations, from Senior Center to Institute of Wealth of Investments to State Bar of Michigan, meaning that a full explanation of Medicare, what it is not. It's really there to kind of cut through, kind of the public information of what is said. That is kind of already known. My important messages are going to be about what is not written, what isn't said, so that you can fully understand your rights and options under Medicare, which are hugely in the consumer's favor. Huge. I'll stay with that message, meaning that I still believe that Medicare is the singular spot where almost all of the options are in your favor, if you understand what you're actually doing. Now, there can be a trick to that, of course. So, annual election period for Medicare will begin on October 15th. It runs through December 7th. You can change your prescription drug plan. You can change your Medicare Advantage plan. That is also the window if you want to go from Medicare Advantage to Medigap. That's the window. The reality is you'll want to know whether or not you can get accepted into Medigap first. The way to do that, one way, is to become our client. All you need to do is go to this website, MaximizeYourMedicare.com, this page specifically, right there in front of you. I'll put it in the chat. Let's just see if I can do that. I have no idea if I know even how to do that. I'm going to put it into the chat here. So, yes, there it is. All you need to do is fill out that form. Your information will never be sold or distributed to others. There are going to be all sorts of new rules. Part of the reason for the subscriber site is due to the fact of the restrictions on people like me. Now, I'm not going to make representations about whether other people are going to follow the rules. All I know is what we can control. We will follow them. We will follow them exactly. That I promise. Okay. On to the show. This is the version. This is the free newsletter. And what I said is I've already kind of reviewed about Medicare. Now, what is news here is that over this past week, we had fair amount of volatility in financial markets. And the point here today is, why in the world is this person this important? And it has to do with debt. It's not close. This person, Jerome Powell, the Federal Reserve Chairman, he's the most important person in the US economy by a very, very long distance. In fact, I'd call him first place, second place, and third place. It's not the president. Sorry, just not. The reality is that he's been telling you that interest rates are going to be higher for longer for quite a long time. This is not new. What is new is the other information around, meaning market participants tried to fight him. It's not been a wise move. It has never been a wise move. It's still not in either direction. And that's my point here today. So what this does, though, is that creates what we see here on the screen, which is a debt problem. And I'm going to go through pretty much for the entire session and then the ripple effects of the issues that this creates. Okay? So now let's just see what I mean by individual debt. We need to first start with the idea of kind of correcting the incorrect notion that all debt is bad. That is just simply not true. It is not that all debt is bad. It is the price of debt, which needs to be compared to the price of other stuff. The issue here is that the price is reflected in interest rates. That interest rate is now higher, notably higher, and you can see it here, which is, this is a long-term version, but if you see in days, you can see here, even since the beginning of this year, early days of this year, you've seen a 1% increase in interest rates. You could think to yourself, okay, 1%, that doesn't matter. That doesn't matter. Does matter. Because interest rates are R here in the formula above. When you start increasing the R, you can see it. The denominator starts going higher, which means NPV goes lower. Right? So instead of 1 divided by 2, it's 1 divided by 3, 1 divided by 4, 1 divided by 5. You can see NPV starts declining quickly because not only is the R higher, but it in the future becomes squared, cubed. That is talking about future cash flow, future earnings, which may or may not actually ever occur because those are uncertain. We don't have a crystal ball. The point here is that because this has started to increase notably as resulting here, you can see that all of the NPVs start to become worrisome. And yes, in fact, that is precisely what has happened. So if you go back up here, let's just see if we can get a better look. What we can see here is you'll see that, in fact, not surprisingly, as news has hit that, oh, by the way, the denominator is going to be higher for longer, what happened is that the risky stuff, notably down here from, let's just call it the end of July, where I saw 46.04 down to 43.20. So let's just call it something like 270 points. 270 divided by 4,600 is quite a notable number. right? 7% odd. Now, the reality is this is what, there's a reason that one of the slogans to this newsletter that sits there on your screen is stocks for show, bonds for dough. You need to understand this formula first. It's got to be first. Somebody once put on what Twitter, it's now X, is, investing and understanding financial markets without understanding interest rates is like eating soup with a fork. That's more graceful and witty than I would put it. Mine is stocks for show, bonds for dough. And that's exactly the case. That it's not only the higher, but what has happened now is that, as you can see over here on this screen, it is the fact that the interest rates moved with this speed. Speed matters. Meaning that the world, people can adjust. People can adjust with gradually higher. That is true. But you can see what has happened here. This here is spiking higher. Now, this doesn't look too much like to an average person, 4.32 to 4.5. In a market that big, for it to move to that degree is like a earth-shattering amount. Earth-shattering. And as a result, you can see what has ended up happening. The ripple effect is to here. The denominator spiked higher. And as a result, the NPVs went lower. And this is what I've been saying, which is that one of the things, the narratives of information that people get about financial stuff is the fact that all of the attention on the news, in the press, they all have to do with earnings per share. Jay's Rib Shack has got great prospects for the future. That has to deal with the numerator. Guess what? Even if people came to Jay's Rib Shack to eat ribs, my delicious ribs, doesn't matter. The bigger, more important markets said no. The longer this persists, the worse this gets. Because as a result, and we're going to talk about it in the next hour, which is that people around the world, the biggest, most important investors, are choosing stocks or bonds. The problem here is if you want to invest in stocks, you now have to compare it to something else. And that is now this over here, which is now 6%, 7%, and far safer. A bond from Jay's Rib Shack is far safer than the stock from the same company, Jay's Rib Shack. Why? Because I must pay the bond borrowers, lenders, first. I have to pay my utility bill before I get to take out my profits. That's what happens at every company. That's why bonds are safer than stocks. They're priority in payment. When you have to pay these guys back, you've got to pay back your mortgage. You've got to pay back your cable bill. You need to pay back your whatever it would be, phone bill, YouTube bill. My YouTube bill is like astronomical. It's crazy. Anyway, we won't settle that today. But before I can go on vacation, I need to pay my bills. In the same way, people have to pay back their bonds before they pay themselves to go on leisure activities. You can see then the issue about individual debt. All debt's not bad. And I want to make sure that people understand and clearly distinguish. For example, when you borrow for a mortgage, when you borrow on a mortgage, what happens? When you borrow on a mortgage, your debt cost is deductible for taxes. So it's two things. right? For example, I'll just increase this and let's insert this row, right? So now a mortgage, especially 2 years ago, was at 3% and tax deductible. So let's just say you had a mortgage payment of $1,000. Out of $1,000, some is interest, tax deductible. So now you can see what my point is. That the current world allows you to get 5-6%. A bank CD, 5%. You can pay back your mortgage at 3%. So you can make 5 and pay 3. So the idea that just, okay, all debt is bad is just simply not the case. It has to do with the price. Today, mortgage rate is what, 7.25%, 7.25. And I've seen some crazy stuff, right? Which is that the average percent now is something like 40% of household income, which seems like tens of percent too high for Jay. I can just tell you that's like sounds like incredibly high. But the point here is that for those persons who had 3% mortgages, you can understand they don't want to sell. Why? Because they can't replace their borrowing at 3%. They would have to borrow at 7%. So as a result, even if that is low compared to other borrowings, it's still cash that they have to pay. And so now you've got this ongoing conflict of vortex, if you will. Vortex is kind of an overly romantic word that Goldman Sachs used, right? So you've got cash flow considerations versus costs, good cost of borrowing. Right? 7% is high in mortgage world. Yeah, but not compared to other worlds. And here it is. So my credit rating is about 800. Okay, somewhere in that area. Spitting distance, maybe a little bit more, maybe a little bit less due to whether or not I hit send on my cable bill, right? This is my guaranteed credit card offering. 29.25%. 29.25%. This is too high. It's too high. And so now I told you that I would say, okay, what would I suggest to people? How to manage the debt. You're to pay down the highest cost of borrowing as rapidly as possible. And the simple reason is that you can't beat 29.25% cost of borrowing. No. This is also why borrowing itself isn't necessarily evil, right? Jerry Jones bought the Dallas Cowboys basically entirely on debt. You've bought the house of your dreams because of the low cost of borrowing. However, low cost of borrowing is over. I think you can safely say that. 29.25%, there's no portfolio unless you are Rumpelstiltskin and you can turn straw into gold where you can reasonably expect 29.25%. The financial markets simply do not have that in here, right? Why do we know? We know the riskless rate is only 4.3%. So how are we going to get on a portfolio basis to beat 29.25%? No way. No way. By the way, I can be wrong here. Why? I could have a crystal ball. Okay. I could have a business which makes more than 29.25%. In theory, that could be the case. Could be the case. Not likely, right? If you happen to have a business, if you happen to have a business interest where you're going to get 50% on the borrowed money, then by all means, this is still okay, right? You get 50%, you pay 29.25%, you get what? 20.75%. More power to you. The likelihood of any business doing this is low. Real low. In fact, not even huge companies can get there. And for example, let's just see what, to give you an idea of an example of a company that cannot, let's just take a look at here. Oh, nope, we missed. The point is that you don't see net margin anywhere close to this of corporate America. Not for most. Apple. Yeah, well, Apple borrows it, very close to the risk-free rate. That's not you. That's not individual people. So it's very, very clear for me. I mean, I don't give financial advice specifically, right, to your particular situation. Today is still not financial advice, as you can see there oops, I'll have the disclaimer up here shortly, right, which is the way to manage the debt is you're to pay down the highest cost. Now, I did not say, very important caveat, I did not say destroy your credit card. I did not. I didn't say don't discard your credit card. I didn't. And the reason is here. Is the value of liquidity and flexibility is now revealed, which is that what credit cards do. There can be other locations, right? This is why you never say never. Home equity loan, reverse mortgage. If you need liquidity, if you need cash, right? And you are put under duress, we need to have locations where you can go. A phone call that you can make. So this is why, while I say you should drive down your credit card balances, that doesn't mean, that is not exactly the same as throw your credit card into the trash can. That is different. Notably different. And you can see this is the way that companies behave. Candidly speaking, what I'm describing here to a CFO of a company is not new at all. Not in the least. This is what CFOs are doing all the time. But even here in companies, and we're going to go to it now, and you'll see where I'm going here, because this will have very important ramifications on what is going on generally. So I've used Jay's Rib Shack as a way of not throwing a stone at, some other small company or et cetera, et cetera. Mom and pop shop, small company, even if prominent in your location, right? Jay's Rib Shack has a huge problem. It can only be that Jay's Rib Shack is going to have a problem in your location. Why? My profitability isn't very good, right? I've got a competitor across the street. I've got Dutch's hot dog stand. Another analogy that I've used in the past, right? My competitor may be smarter. My competitor may have better, cheaper access to money. Absolutely can be the case for whatever reason. Maybe he saw this. He locked in low cost of borrowing for a very long time. Maybe he has cash in his bank account that Jay's Rib Shack, maybe that Dutch's hot dog stand has it, Jay's Rib Shack doesn't, for example. I have had other videos here on this channel, right, which have talked, and that is the reason That is the reason that I've talked about Silicon Valley. To tell you what a long year ago that this was less than 6 months ago. It's like unbelievable, right? So Silicon Valley Bank, something that many people know, right? Failed. We've had more failures of banks this year than at any time in 40 years or something like that, more than the financial crisis. The point is that they're sitting on a bunch of different things. Remember, on this channel, I have made this analogy on many occasions. They own brass elephants that they are clinging on to, caressing like I am. They think it's worth $1,000. If somebody wants to pay me $1,000, info@gh2benefits.com, by the way. Anyway, I like it. I don't like it that much. My point is they've got it on their books at a price that doesn't reflect market reality. This is allowable under rules. It's allowed. But what is it? Commercial real estate. The strip mall, the one with 3 vacancies, it's still on their books as if it was the original price. But the reality is, today, if you try to auction off the office building where there's 30% vacancy, you are nowhere close to 100. Readers of Jay's Corner, the newsletter, has pointed this out. We've had auctions in big places where buildings were where I thought was $1,000 worth and is sitting on my books as if it's worth $1,000. The best it got was $600. Oops. This minus $400 either goes to earnings or, guess what? I presumed $1,000 by which I lent to who? Jay's Rib Shack. If now all of a sudden this is only worth $600, what does that mean? I can't lend to who? Jay's Rib Shack. I've got to do one of two things. I'm going to either tell him no completely or I'm going to jack up his interest rates. That's the rational thing to do. What happens then? Jay's Rib Shack goes, well, I can't compete with Dutch's hot dog stand at that rate. I'm closed. The reality is that this is not very complicated, right? I mean, the point of this channel, the point of the newsletter is that just to use your common sense. There's the reason I'm not using, complicated language like net interest margin and slope of interest rate curve. You want to get into that, no problem. But for everyday all you need to do is think using your common sense, right? I relied on the value of this to make loans to Jay's Rib Shack. Guess what? This thing, I don't know what the price is. I've got my emotional attachment to the fact that I bought this in Mumbai. Yeah, so for me, it's valuable. On auction, it's not valuable. And as a result, since I can only lend based on the value that the world believes it's worth, I've got a problem. I can't resolve easily either. Right? Because now, what? I'm going to have some magical buyer at back to 1,000? Who? Someone like me? No. And that's the point. This is happening at banks everywhere. It just so happens the JP Morgans, the Bank of Americas, they're so big that they have the ability to withstand this. However, the smaller banks don't. And that is part of the reason that deposit base has declined to this degree. So that's Jay's rib shack, right? Small companies, you will see this. You will see headlines. It's almost for sure. It's not me making heroic predictions. It's just attaching common sense. There will be high yield bankruptcies. There have to be. There's no other logical, reasonable path here. There's no other conclusion. Now, does that mean every high yield company is going to start defaulting? No, right? Because again, right, like I said up here, right, value of liquidity and flexibility now revealed. Who knows this? CFOs. So now let's just say Jay's Rib Shack had a hotshot treasurer. What did he do? He borrowed bunches of money at 2% to weather this storm. So by that same token, I would not necessarily say you're going to have this cascading default by all the Jay's Rib Shacks of the world. It's not going to happen all at once. There are going to be headlines. There are already headlines, meaning that I borrowed, Jay's Rib Shack borrowed at 2%, but for 5 years. And then after that 5 years, I've got to re-borrow. Guess what? I'm not going to get 2%. I'm not. So, but you're going to have this in stages, company at a time, one at a time, one at a time, having to reset their borrowing level. Invariably, Jay's Rib Shack, Dutch's Hot Dog Stand, Jim Bob's whatever, pizza parlor. They're not going to be able to afford to borrow to finance themselves. And on it'll go. For big companies, different. For the largest companies, different. We still do not see that large companies are having problems, right? Which is, you can see equities down. Earlier today, I discussed about the fact that I've got like in a household, you've got your mortgage, you've got your rent, you've got your utility bill, etc., payments that you have no choice but to make first. And then you've got, I'm going to go out to fancy dinner, I'm going to go out to vacation. In the same way, a company, they've got to pay the bondholders first. They have to pay their borrowers the money they borrowed from banks and in bonds first. And then the stockholders benefit because they are entitled to what remains retained earnings. Okay? So there can be some inherent clash. Yes, that is, corporate finance 301 beyond Jay's corner. Yeah, maybe for the subscription site. And even then, not too much. So large companies here, you are not going to see wide scale default. We are miles away from that. We're miles away from that, of course, under the presumption, that we have that we don't have, long run types of, certain odd events. Here's an odd event. Yeah. Something like this. In other words, you will not have the big companies fancy. Why? Because they locked in. They've already locked in the fact that, let's just see if we can get back over here. What'd I do? There's still user error. There's still always user error. Here it is. The fact is, they have the apples of the world. The apples of the world have already locked in for 10 years, if not longer. They can borrow for 30 years. They can. But 10 years, 20 years, they can offer other types of borrowing instruments. They've already done so. So as a result, they can make back and repay their borrowing, much to the relief of the bond owners. I do need to say, however, that does not mean, and a very important point when it comes to how investments and how these instruments actually work, that's my point here on this channel, is a bond fund is not the same thing as a bond. It's an important distinction to make. Let's not have it in this ugly gray. Right? It's an important distinction to make. A bond fund is not the same thing as a bond. A bond, a single bond, it's going to keep paying. So let's just take Apple Computer. Apple Computer has borrowed, let's call it 3% for 10 years with 8 years remaining. They're going to continue to pay 3, and then pay 100? Yes. No problem. I think it's safe to say people will not be able to wean themselves off the Apple Kool-Aid. Apple will have the cash to pay back the bondholder. That said, between now and then, the market price can still fluctuate. Existing market, let's stop this all cap stuff. Existing market price can fluctuate and not be worth 100. And the simple, not very simple reason is because of this, which is now other companies, if they were to borrow new, they may have had to borrow at 7%. So as a result, the C's are 3, the R is 7. This is not worth 100 any longer. And I've already gotten too complicated, I realize. My point is, the NPV here can be lower than 100. The only time for sure it'll be at 100 is when it pays back the principal in full. That's the single time. Every other date, there's a snapshot. What's the NPV? What's the NPV? So now let's say you've got 2 bonds, Apple Computer, General Mills, and let's not call it Boeing. So while those companies will have borrowed for already locked in 3%, if someone tried to buy that bond, they would not pay 100. Why? Because they know that Northrop Grumman has a new bond which pays 7%. So I would not pay 100 for the Boeing bond. The market price would be different. A bond fund is the average of market prices. And I've taken a huge shortcut, so if you're a bondolero like I am, don't throw mud. But basically a bond fund is the weighted average value of all the bonds in the fund. These are not the same. Meaning that the bond, as a result, the bond fund can have a price which is not 100, even if we are very certain that even if we were very certain that each bond is money good. It's important why. It's important why, and I'll show it to you here. Because you can see here, let's just go here to this website, is that this is how when you see your portfolio and you go to your 401k or whatever it would be, you will see this. This is the age-old single number that correctly describes the most diversified portfolio of fixed income or bonds. You can see this is a fair move here, right? Which is from 100.79 down to 95. So this is not without price volatility. And this is my point. Bond is not the same thing as bond fund. And by bond fund, that's ETF, because it is operating in a similar way. ETF is just a weighted average of the subcomponents of the individual bonds. So when interest rates move, are moved around, even if the ability to pay, willingness to pay of Bank of America, Boeing, Apple is unchanged, the price NPV is still lower. The bond fund is lower. That's it for you as a person, Jay's Rib Shack, as well as the highest, biggest companies so far. And this is pretty much the case around the planet, meaning Daimler-Benz is still money good. Okay, this is not the situation where we're afraid that every company is going to start defaulting. No, we don't have that. But will we have price volatility? We definitely do. Like I said, we've gone from, just by this graph alone, this is not very long. In 6 months, you're minus 5%. 7 months. So not great again this year for the bond market. Oh yeah, by the way, to give you an idea on how peculiar and why I've been on stocks for show, bonds for dough, is that this misunderstanding here is really, the narratives here are just incredible to me. Which is, you can see, let's go to the max. Interest rates from here to here have been in a one direction down. Not for a year, for 40 years. 40. R has been a straight line down. So NPVs of everything is higher. This is part of the false narrative, right? In other words, people glossed over this. They put a black marker under the denominator. And they took false credit saying, oh, see the numerator. Tongue deeply in cheek, I call those people the citizens of Numeratorville. That's not a compliment. Okay? The ones just saying only this, only pay attention to the numerator, taking false credit as if that was the actual reason. How about all the biggest money on the planet is concentrated on the denominator by many times? In which case, what do you have? You've got, of course. You've got what? You, of course, have NPV straight higher. The end. On that alone. On that alone, you can see what has happened. Okay. That said, not everything is great, right? And you can see it here. Well, let's just make these small, and I'm going to make these all small now, right? Well, let's shut all these down a bit. This, of course, is the worry. I'm not going to overstate it. I'm also not going to understate it. Because at the same time, what has happened here, because the cost of borrowing is higher, that means the cost of borrowing to the U.S. government is also higher. Also higher. Let's just see. To give you an idea on what it is, let's just see. This is the national debt. So we've had stimulus checks and we've had, TARP when the housing crisis occurred. I didn't say that it was wrongly formulated or that it was an emergency situation. If there's an emergency, there's an emergency. I get all that. But because of the fact that the United States owes so much money, that it is also borrowing at a higher cost. So just like Jay's Rib Shack, right? Who can no longer borrow at this cheap rate. What you also have is governments having the same thing. And notably, the most important bond market is here in the United States. So now you can see it here. Is that if you are talking about a bond market where we've got national debt growing, global investors know this. They do. If they don't think that the US bond market is going to continue in this way, meaning denominator ongoing lower, they simply stop buying or start selling, making this problem worse because it needs to pay back, and the way it pays back is by selling more bonds, which now increases the rate at which they have to borrow. And now you have this cycle in reverse. I'd love to tell you that, oh, well, that's the worst it gets. And too deep in the weeds here for today. Too deep in the weeds for the general Jay's Corner is what I would say. Yep, too deep in the weeds for that. Is this fact here? People ask me, okay, Jay, what keeps you up at night? Well, what keeps me up at night is, the idea, number one, that the Cowboys could lose due to the fact that this star cornerback is now hurt. That's number one. That really is a problem. And joking aside, the second problem is there's a problem that we cannot solve. We cannot solve this problem. I've pointed it out in the past. It's going to be our punchline. Give you, just in case you're going to overeat this afternoon while watching college football. Maybe this will wreck your appetite. I don't have a solution here, right? We have a solution for Silicon Valley Bank. What? Federal Reserve takes over. The Department of Treasury takes over. Tries to liquidate in an orderly fashion. No problem, right? We had measures that the Federal Reserve took and the Treasury when the great financial crisis occurred. What'd they do? They insured money market mutual funds. That's number one. There was TARP. That's number two. Those two by themselves. We would have been in Shantyville. Literally. The entire economy was locked. There was no liquidity. No liquidity. Meaning over here, right? During the Great Financial Crisis, this is what happened. This was zero. For the economy. Not just for Jay's Rib Shack. It's over. So, in those cases, there was a federal answer. There were measures that central banks coordinated. Central banks rippled around the globe, all basically reading from the same playbook. Increase liquidity, backstop banks so that they could make payments so that the economy didn't come to a screeching halt. Over here, however, is the issue. is that $65 trillion of additional dollar debt being held by non-US institutions via currency derivatives. The issue is that they raise the concern that the debt is unrecorded on balance sheets. Unrecorded on balance sheets. In addition to these debts, and just to say, not this type of debt is at companies or at big pension funds. And the only way to do this is with a bank. So Jay's, in Jayistan, right, we've created this kind of agreement with Goldman Sachs. We've not reported it. It's not on a balance sheet because we have it using complicated stuff, derivatives. My original home. The issue is you don't know how to track unrecorded because of accounting on how to track derivative positions and foreign exchange swaps here. This is why when I say stocks for show, bonds for dough, that the very close cousin to bonds is foreign exchange. Because of the way that you can buy and sell bonds euro denominated. If you're denominated in dollars, you can buy a foreign currency bond. I have discussed this. Carry trade at Hiro Nakamura. I showed you this. And for subscribers, later today, you will have access to this entire spreadsheet. So you can click through here and go through these crazy number of different topics. Just maybe a good double-edged sword. But you can see this here is that it relates back to here, which is that on derivatives debt. The issue here is you can't quantify it. And the second thing is we don't have a way for the central banks to coordinate to actually capture and actually do something about it if it starts running out of control. This is a tinder box, which is been out there. This is the one that keeps me up at night, right? Because the rest I can kind of get. It doesn't make life any easier when laundry detergent is $15, $17. Cheerios is $7. It's not about that. But these ripple effects over here, because those are known, right? You can not do the laundry every single day like I do. Right, you can stop eating Cheerios. You can eat, Cheerios, right? The generic brand. Push down the price. Push down your costs. Okay, that part I get. But this one, if the toothpaste starts leaking out of the tube, very, very difficult to get out. And now also at a higher cost to fix. Why? Because this cycle here, and you can see it down over here. Straight line down and now spiked higher. That is a long-term issue that we'll all have to deal with. Not sure, I woke up in a good mood. I'm still in a good mood. But jo.substack.com. You can send emails, info@gh2benefits.com. Coming up at the top of the hour, right at 11 o'clock, you're going to be able to go over to this website here. There it is right there. I'm going to go online at 11. I'm going to be talking about a different conversation that I had with Aunt Lester, who ran targeted date funds from the beginning. She's a pioneer. We had conversation 2 months ago. I've been too busy, so I haven't had to make comments. So I think the best thing for me to do is just make comments on it live. We're going to go through some of the nuances. Literally, there are 10 hours at least of comments I could make about that conversation. That's coming up at 11 o'clock. Thank you so much for joining. Go Blue today. Today's a trap game, I think. Let's hope not. Thank you very much. jo.substack.com. Speak to you next time.